let me describe a real possibility in the stock market. Lakhs of investors have been affected by this. You see a small company's stock up by 10% in just one day. The volume of this stock is 10x higher than its yearly average. It's a penny stock. Now suddenly, conversations about it pop up everywhere and you rush to buy it. As soon as you buy it, it's up 10% once again on the very next day. You feel like you've struck gold. But guess what happens? The stock makes you some profit over 1 week, and just before you could sell, it falls 10% again and hits a lower circuit. The stock exchange stops further trading in it, and next day it is lower by 10% again. You are unable to sell. This goes on until you've lost nearly 50% of your initial investment, let alone make a profit. You, my friend, were victim to stock manipulation. Now, why did I present this scenario to you? Because one of the largest stock manipulators in the real world, Ketan Parekh, is back.
साल 2000 में हुए स्टॉक मार्केट स्कैम का मास्टरमाइंड केतन पारेख एक बार फिर सेबी के शिकंजे में है.
Past interim orders against Rohit Salgaonkar, Ketan Parekh and certain Kolkata-based entities on allegations of front running.
बड़ी खबर है और जिस तरह से केतन पारेख का नाम पहले भी शेयर बाजार के घोटालों में आया था, केतन पारेख आज भी सक्रिय था.
After scam 2001, he's made a special reappearance for perhaps scam 2025. But why? What is he up to now? Investors lost thousands of crores when he was last active in the stock market. So naturally, the question begs to be asked, should we be worried this time around? I'll share all the important details and most importantly, you'll understand how to train your own eyes to find dangerous looking patterns in the stock market. This is so that you can protect your hard-earned money from predators like KP. Watch this video till the very end because I'm going to share some crazy insights about penny stocks and some of their best kept secrets that these manipulators won't tell you. Welcome to Personal Finance TV. My name is Aditya Iyengar, CFA. Let's get started. In 2025, SEBI was investigating Ketan Parekh and a Singapore-based trader named Rohit Salgaonkar for over 30 months in a new front-running scam. To understand what front running is or what Ketan Parekh is up to now, you first need to break down what happened almost 24 years ago back in 2001. Ketan Parekh was a humble chartered accountant who started his career at a well-known institutional brokerage called NH Securities. He then joined a company called Grow More Investments. This, by the way, is the same company that Harshad Mehta founded and used for his activities in 1992. Naturally, Ketan Parekh, just like Harshad Bhai, also had a proclivity for the illegal stuff. Now comes the interesting part. In 2001, Ketan Parekh would purchase small stakes in companies with tiny market capitalizations and circular trade them. What that means is, imagine this. I have 10 shares of a tiny company called Ketan Corporation. I call my friend Priyanka and ask her to buy these 10 shares from me. I even give her the money needed to do this. Then I ask Priyanka to sell these shares to my other friend Vidhi. Then I have Vidhi sell these same shares to my other friend Riya. So the big question is, why am I asking all my friends to buy the same 10 shares from each other? It is because I want to create fake volume. I'm doing this to show artificial trading activity in Ketan Corporation's shares. So in reality, these 10 shares stayed constant. The only real volume here was me buying them. After that, when I had my friends pass them around, there was no real demand for them, but I made it look like there's a lot of trading activity in Ketan Corporation, even though it's the same 10 shares. Now, this works when the company is tiny like Ketan Corporation. If it's a company which is worth, let's say, 1 lakh crore, it may not work. And whenever there is a spike in the volume, especially for a tiny company, its stock price skyrockets. And how does that benefit me? I get to sell my 10 shares of Ketan Corporation at a much higher price. It's like buying a stock and then deciding what profit I get to sell it at. What Ketan Parekh did was, through a network of rathole accounts, he bought shares of small companies with not much trading activity. Then he used another set of accounts to create this fake trading activity. Then finally, when the market would notice this abnormal volume, it would be quick to show interest and buy the stock. Once there was sufficient hype and demand, Ketan Parekh would dump his own holdings kept in his personal and the rathole accounts and walk away with crores in profit. He did this frequently with a group of 10 listed companies called the K10 companies. K10, Ketan, you get it? Now initially, Ketan played a small game. He used circular trading to make some money and realized that he wanted scale. So he went to the promoters and founders of failing companies and made them an offer they cannot refuse. He asked them for large sums of money that he could use to inflate their share price and improve the investor sentiment by doing the exact same circular trading that we just described. This money would later be returned to the promoters after deducting a small commission. This was easy to do because small companies see sudden price jumps when someone buys the stock in large quantities. This excess demand and sudden price jump in the stock due to high demand and low supply is called market impact. Now, having a high stock price mattered for the founders because this was the early 2000s, a time when more and more companies were getting listed at peak valuations. The dot-com bubble was at its all-time high and having a great valuation was all the rage. With a high valuation, a company can raise more capital by selling a small stake if needed, and the founders can make more money if someone acquires them. With this arrangement, someone like Ketan Parekh could also front-run trades. Meaning, if he knows that a large quantity of a stock is about to be purchased, he would first buy it for his own account and the rathole accounts. And then, when someone buys this stock in large volumes using the promoter's money, which was again Ketan Parekh, the price would rise and he would dump his personal positions and make money. Now, spoiler alert, both front running and stock manipulation are illegal if you haven't figured that out already. Now look at this example. A company that nobody had heard of saw its share price zoom from 625 rupees to 8,400 rupees in just a few months. Now this happened back in 2001. Ketan Parekh then got caught, his gains were impounded and he was barred from trading for 14 long years. But old habits die hard. Let's answer the bigger question. What's he doing today? Newsflash.
Now, a familiar face from the underbelly of the stock market, Ketan Parekh, seems to be back in the news, but this time it's not for his bullish stock picks. He's resurfaced in a whole new scandal.
The exact same thing. In 2025, KP was accused once again on charges of front running. KP, Rohit Salgaonkar and a bunch of others acted as consultants for a Los Angeles-based fund called Capital Group. And obviously, they had access to a lot of insider information. They knew exactly which stocks the fund was about to invest in well in advance. And whenever a large fund invests in a small company, there's that market impact we just discussed. So whenever they knew that the fund is about to buy a large quantity of a particular small cap stock, they would load up on this stock in their personal accounts via friends and family. This way, KP, Rohit Salgaonkar and his buddies made 66 crores of unlawful gains. These also have been impounded, by the way. But how does this impact you? How can you stay safe? Because back in 2001, when the K10 stocks collapsed, when KP got caught, every single person, including you and me, lost crores. The equation is very simple. If a stock's price moves way too much, it is a red flag. There are forces behind it that you and I may not be aware of. If something looks too good to be true, even on the price chart, it just might be. So let's say you are a beginner, stay away from penny stocks and stick to the blue chips and mutual funds. As an experienced investor, invest purely on the basis of fundamentals because either today or tomorrow, the price reflects the financials of the company. Anyway, have you seen an opportunity that looked too good to be true in the Indian stock market? If yes, tell it to us in the comments below. And if you learned something new, consider leaving a like and subscribe to Personal Finance TV. I'll see you in the next one.